and welcome everyone to Impact of COVID-19 on Hedge Funds. We've been really looking forward to this webinar, hosting it with Amy Benstead. I'm Zachary Seferati from Dalma Capital. Amy Benstead is from Preqin. Preqin is one of the leading the leading data provider really on the hedge fund industry. We certainly consume their data frequently. She currently heads Preqin's data products team, guiding Preqin's strategy and delivery of data services. As Preqin's hedge fund expert, Amy is a regular contributor of articles and features in the financial press, and her research is featured in the Financial Times and the Wall Street Journal, as well as in the specialist hedge fund media. Amy is a keynote speaker at several key industry conferences. I can say that she's been an amazing speaker at the AIM Summit conferences over the years, and we've met at several other conferences beyond that. And she graduated from Imperial College London in 2003 after gaining a BSc in biology and an MSc in applied biological sciences. We've been really looking forward to having this webinar after a lot of requests of people trying to understand the impact that COVID-19 has had on the hedge fund industry, on different hedge fund strategies, and there is literally no better source in the world of that than Preqin and Amy Benstead herself. So I'm excited to have the foremost expert on hedge fund data, hedge fund performance, assets, here with us today to present some very insightful information on what is happening to the hedge fund industry, how that impacts investors, how that impacts managers, and what the outlook is, how the outlook may have changed for the industry since COVID-19 has happened. So without further ado, it's my pleasure to hand over to Amy and thank the AIM Summit team for organizing this. Just to mention, we have members on this session from over 30 different countries, including institutional investors, family offices. So thank you all for joining us, and we hope you enjoy the session.
Thank you for that, Zach. That was a really lovely introduction. I appreciated that. And thank you also for inviting me to speak today and to present some of our data. It's really, we really miss getting out to conferences and being able to do these presentations face to face. So it's such a wonderful opportunity to talk through some of our data today. As everyone is aware, COVID-19 is drastically impacting the world today, affecting not just financial markets, but the wider global economy, small and large businesses alike, and of course, our everyday lives. And today I'll be walking you through some results from Preqin's latest research on the topic to help provide some insight into these challenging and confusing times. I won't give an introduction to myself because Zach has done a great job, but just as a bit of background and insight, I've been at Preqin for 14 years and we was only 20 people when I joined, but now we're up to about 500 people globally. And in that time, I've been covering our hedge fund business. So my first job was to begin actually our hedge fund database, which is now used by thousands of financial professionals globally. So I've been working in the hedge fund space since before the GFC, and have some experience of seeing how hedge funds have fared through other economic crises over the longer term. So in terms of the agenda, it's a pretty broad coverage today, and I want to cover several topics throughout my presentation. To start with, I'll be looking back to the start of the year to give a bit of a deeper dive into how the alternative assets landscape looked at the start of the pandemic, to sort of establish a baseline of where we were in terms of the alternative asset world. Then I'll be using a combination of a survey data, and we've been carrying out many surveys throughout the pandemic in order to gauge LP and GP sentiment. And we've been surveying several hundred LPs and GPs, in fact, throughout the last few months to really understand how this is impacting them. And we'll be combining that data with our data on 12,000 institutional investors, 20,000 institutional fund managers, as well as all of the funds that they track, in order to give a real deep dive into the impact that COVID-19 is having on the alternative asset sector real time. And then finally, I'll be focusing on the hedge fund industry and how it's been affected by the COVID-19 crisis. I'll look at some hedge fund performance data to see how well hedge funds have navigated the market turmoil. And I'll also explore how investors are reacting and how their plans for 2020 have changed in recent months. So first things first, what did the alternative assets landscape look like as we started the year? The chart shows assets under management over time across all alternative assets that we track. And although COVID-19 has clearly had a sudden significant effect on the global economic activity, prior to this, we saw a period of unprecedented growth, really triggered by the fallout of the GFC. So back in 2008, alternative asset managers commanded around 3.1 trillion. Over the course of the 11 years to the end of 2019, that more than tripled to about nearly 11 trillion in assets under management, and that's as of December 2019. And we also tracked a huge uptick in the number of institutional investors who have been actively investing in alternative assets over that time. So back in 2008, there was around 3,000 investors globally who had exposure to one or more alternative asset. Today, we're tracking well over 12,000 institutional investors who have exposure to alternative assets in their portfolio. And what we're seeing increasingly is it's not just investors from markets such as the US and Canada and Europe, particularly in Western parts of Europe. It's increasingly investors from other parts of the world. So there's a lot of investment from the Middle East, increasingly new investment from Asia, countries such as Japan and South Korea. We are seeing more and more investors begin to allocate to alternatives for the first time. So there's a huge source of new capital for the fund managers out there. Private capital, so this covers everything from private equity and venture capital through infrastructure, natural resources, real estate and private debt. And this has been the primary driver behind this growth, particularly in the second half of the last decade. Hedge fund AUM really ramped up very quickly at the start of the 2010s, but we saw that begin to plateau from 2015 onwards, whereas private capital assets under management has really shown strong growth. It now stands at 7.2 trillion, and private capital fundraising has bypassed the $1 trillion mark for the third consecutive year in 2019. And this represented a record year for fundraising for real estate, infrastructure, and natural resources. However, a trend that we have seen is while the amount of capital is growing very, very quickly, over 1,000 fewer funds closed in 2019 versus 2018, as investors are increasingly seeking the larger and more established managers for their private capital investments. So we've seen a real trend of capital consolidation within the alternative asset world as investors seek that safety of the larger managers. And therefore we see a big dispersion in the industry, and the difference between the haves and have-nots are growing larger, and the smaller funds are finding it takes them longer to reach their fundraising targets, and also often having to reduce the targets that they have. As well as increased fundraising, we also see dry powder levels being at record highs, with private capital fund managers sitting on over 2.6 trillion in capital reserves. On the hedge fund side, it's a different story. So AUM has continued to rise, or it did continue to rise over the course of 2019, albeit at a slower pace than private capital. However, that increase has really been driven by performance gains. So it's a trend we've seen over the last few years. Investors have been pulling money out of hedge funds as a whole year on year since about the mid part of the last decade. So 2019 was undoubtedly a challenging year for the industry as investors continued to rethink and rebalance their holdings. And they withdrew a net 97 billion from hedge funds over the course of the year. And that had a few effects. The main one is that we see many, many more liquidations last year than we have seen in previous years. And in fact, the number of fund liquidations have exceeded the number of funds launched. So we've seen a contraction in the size of the number of hedge funds out there to serve those investors. However, last year with performance hitting 10-year highs, despite the redemptions, we did see AUM growth go to nearly 3.6 or to over 3.6 trillion in assets under management. The previous year, when performance turned south and hedge funds made losses, we saw assets under management decline. So it's really performance gains that are buoying up the size of the hedge fund industry, and that has impacts to what we're seeing this year. I will discuss that later. So looking at what has fueled this growth, simply put, it's investor demand. So I've spoken a lot about investors already, and that's because as a business, Prequin, we work really, really closely with institutional investors. We have daily conversations with groups like pension funds, sovereign wealth funds, family offices to understand their needs from alternative assets. And we've seen over our 10-year, we've been around since 2003, more and more and more investors are making their first allocations, but even more than that, they're growing out deeper and more sophisticated portfolios of alternative asset products. And that means that more capital is flowing into these asset classes. And why are they doing this? So if you look at the chart on the left, which is quite a lot going on, and there's a lot of information there, it highlights some of the key reasons that investors are allocating to each alternative asset that we track at Preqin. And this is based on surveys of institutional investors that we carry out every year. So this is from our November 2019 survey. Diversification is key, obviously. Investors are looking to alternatives to diversify their sources of returns and also to help increase yield. But if you look at the reasons on an asset by asset basis, you see differences between each of the asset classes that Preqin tracks within the alternative asset space. So something like hedge funds, it's a quest really for risk mitigation in their portfolios today. That could be through reduced volatility or for reducing correlation to public markets. For a product like private debt, where we've seen very strong investor appetite over recent years, it's more around adding a reliable income stream. And then for something like private equity, which has now exceeds hedge funds in terms of assets under management, it's really around adding a source of high returns, be it on an absolute or a risk-adjusted basis. And the chart on the right hand shows you that indeed it is the ability that private capital funds have been able to do in terms of performance, which is keeps investors coming back for more and more. So the chart on the right hand side of the screen shows you that private capital funds of vintages between 2011 and 2016 have consistently posted returns in the 8 to 15% range, with private equity funds being particularly successful. The median net IRR for private equity funds of vintage 2007 to 2016 stands at 14.9%, cementing its place as the largest alternative asset class, with 4.1 trillion in assets under management. So these strong gains that private equity funds have shown really keeps investors coming back for more, particularly as they distribute more capital back to their LPs. We see them reinvest that capital and also increase their exposure over time. So on the topic of performance, these charts show you how, well, the chart on the left shows you how investors view performance across each area of their alternative asset portfolio. Again, this is based on a survey we conducted at the end of 2019. So this is very much setting the scene for how investors viewed alternatives going into the crisis. As you can see from the chart on the left of the screen, over 80% of investors we surveyed in November told us that performance either met or exceeded their expectations during that year across most asset classes. I'd say the notable exception here is hedge funds, in which 40% of investors reported hedge funds were not meeting returns. And this actually was quite a surprising result, I'd say. It was last year, hedge funds delivered over 11%, which is comfortably in the range of most institutional investor return requirements. The way that we read this result is that there was continued concerns from institutional investors, which have been bubbling away for a few years, particularly around performance relative to public market and performance relative to the fees that those products have, and could they get better returns for lower fee products. And it's almost as a hangover of this multi-year trend that we've seen, which has been leading to a lot of the redemptions that we see. And the chart on the right-hand side of things shows you how investors were viewing performance and what their expectations were for the year ahead. So for this year, for 2020. And what we noted at the end of last year was for investors largely to be expecting more of the same, for alternative asset returns to continue to deliver, or in the case of hedge funds and natural resources, to improve even further. However, and I will discuss this later, a lot has clearly changed in the world since November 2019. I don't think any of us back then were really expecting to be doing webinars like this in our spare rooms, in our offices. Nobody really saw COVID-19 coming. And while the vast majority of investors expected this strong performance to continue into 2020, it does seem inevitable that these expectations would need to be revised in a post-COVID-19 world. And we'll dive into that in a little more detail as I get through the slides. Before I do that, I just also want to highlight the level of confidence investors had in alternatives going into 2020. So this chart here shows you whether investors plan to put more money and more capital into each alternative asset, that's the orange bar, or less capital into each alternative asset over the course of 2020 compared to 2019. And pretty much across the board, 80% of investors plan to invest either the same amount or even more in the year ahead than they had done previously, with lots of support for private capital like private equity, private debt. So we were going into the year as a business really strongly expecting fundraising to be very robust over the course of 2020 as investor sentiment was so strong. And it is due to that confidence that Preqin made what we now see as quite a conservative prediction in our Future of Alternatives report in 2018, that industry AUM would reach 14 trillion by 2023. Now, we will monitor this estimate closely in light of challenging market conditions and revise if we need to. But the fact remains that the industry is already outpacing that projected growth and was already running approximately 12 months ahead of schedule. So although there are challenges ahead, and we think that fundraising and assets under management will be impacted as a result of the COVID-19 crisis, the longer term growth potential very much remains positive for alternative assets as a whole. So that is how the alternatives market stood prior to the outbreak of COVID-19. However, the world clearly feels like a different place now than it did even a few months ago. And Preqin has been speaking with hundreds of investors and fund managers to get an early view into what is happening across the market and how the outlook may have changed. And we'll look at some of that data now. So firstly, looking at private capital fundraising from Q1 2015 through to Q2 2020. So this data is fresh as of yesterday. There are clear signs of a contraction across private capital. The chart on the right-hand side shows that quarterly fundraising in regards to capital raised over the quarters and is shown in US dollar billions. So if you want to interpret it, it shows you how much capital is raised. In Q1 2020, global fundraising was down 30%. And that was the lowest quarter since Q1 2018. And we also saw the fewest number of funds reach a final close for several years. It's actually the large funds that helped to boost the total amount collected. For instance, in January 2020, Lexington Capital Partners 9 closed on 14 billion, continuing an industry megatrend where we've noticed previously that large funds from more established managers are securing considerable capital commitments. As I mentioned earlier, capital consolidation is very much a real thing in the private capital world. In Q2, the fundraising contraction continued even further, with just 195 billion raised over the course of the last quarter. And over the year so far, we've seen all regions and all strategies being impacted. And I've put some stats on the left-hand side to show you how that's changed from quarter to quarter. So that's the quarterly change from the previous quarter. Perhaps unsurprisingly, Asia was hit the worst in Q1. However, we have seen that rebounding in Q2 with the level of capital still well below the typical quarterly totals we are seeing. So that's the yellow line on the chart there. But there are some positive signs that a recovery is in motion already. And while fundraising in Europe was down, also in Q1, in Q2 we noticed a recovery closer to what we would see as normal levels of activity for European-focused funds. North American funds, which is the blue line on the chart, however, have been hit the hardest. Q1 totals were down 18% compared to Q4 2019. And then Q2 totals were down a further 34% from Q1 2019. So we'll certainly be keeping our eyes on these funds over the course of the rest of the year to see whether these trends are reversed if and when the COVID-19 pandemic comes under more control in the US, because the US is such a key driver of capital within the alternative asset sector. So looking at reasons why. So I've already mentioned a few things about investor appetite has really been the driver of the growth that we see. And that is also the reasons why we're seeing fundraising slowed down. So this chart shows you a result of a survey that we carried out in April this year in order to gauge investors' early reactions to COVID-19. And it's clear that many investors are revising their plans after coming into the year full of confidence and full of hope to be able to invest more money. The two bars to pay attention to here are the grey and blue ones, which represents those investors that plan to significantly or slightly reduce their exposure. And as you can see, 60% of surveyed investors now plan to decrease the amount of capital they will commit to new funds over the course of 2020, while 59%, so almost the same, plan to reduce the total number of commitments they're making, specifically as a result of COVID-19. So what we're expecting is for there to be less money earmarked for new investments, and also again for that to go into the hands of a smaller number of managers. And obviously this was 2 months ago, but the drop off in our fundraising stats does bear out, and this change in tack as we all try to get to grips with the way that the pandemic will reshape the investment world. On a similar line, when speaking with GPs in April, we noted challenges in fundraising. So although nearly 30% reported to us that it was not having any impact on their ability to fundraise, over 50% noted that it was slower as a result. And a notable third saying it was significantly slower. And even amongst that group that we surveyed, which was a couple of hundred fund managers, we saw a handful of fund managers report that they actually even abandoned their fundraise as a result, and they were going to wait and see how the pandemic panned out before they moved on, reopened their fund to new investment. So taking that one step further and looking more about how wider fund manager operations have been impacted, I'd say the bar to take interest in here as a grey bar, which represents a positive impact, and the orange bar, which represents a negative impact. Now, as I mentioned before, perhaps unsurprisingly, the main areas of impact has been fundraising, and also on deals origination, as well as the restrictions this places on portfolio company operations. A key issue for fund managers is how to conduct on-site diligencing of potential companies and how to value portfolio companies and potential targets at a time when many businesses are seeing decline in revenue as a result of the global economic hiatus. And this can also make sourcing debt capital difficult. However, some areas have been impacted less, and it's encouraging to see that GPs are doubling down on their IR with existing investors as they seek to help their LPs navigate through the disruption. And that's certainly something that we've heard a lot of from investors, is that the communication from their managers has been very, very strong, and they've found that has helped them navigate the crisis more successfully than, say, the GFC 10 years ago, 12 years ago. The chart on the right shows you when managers expect operations to return to pre-COVID status. 3/4 expect this to be within the next 12 months, so that's from April, and including 40% who think it would be within the next 6 months, so basically by October this year. I'm not sure I would include myself within that 40%. But there's a significant number who think this could go on for even longer. So 1/4 of our managers that we spoke to believe that this could go on for longer than the next 12 months. Finally, looking at how COVID-19 is impacting deal activity. And deal making, unsurprisingly, has also taken a hit. Although global buyout deal flow in Q1 was largely in line with previous quarters, and deal volumes even actually improved slightly in Europe and North America, Asia saw an 80% fall in aggregate deal value. And that represents the worst quarter for Asia deals in 11 years. But positively, we saw a strong recovery in Q2 as the pandemic moved on from Asia to Europe and North America and other parts of the world. In contrast, where activity in Europe and North America looked undampened in Q1, there was a steep drop-off in the second quarter, so last quarter, and that's contributed to the lowest level of deal activity since the first quarter of 2016. Similar to the fundraising market, both investors and fund managers will choose to take stock in these early days, meaning that new deals are likely to be postponed as we wait to see how the market reacts. And then finally, thinking about the impact of deal making on performance, At Preqin, we've been doing some new analysis to model the potential effects of a recession on buyout returns. We used a pandemic scenario developed by a US-based risk management company called FRG and applied it to the Preqin FRG cash flow forecaster. We then compared this result with a baseline economic scenario in which there was no pandemic. And we found that as valuations fall, 2018 and 2019 vintages, previously the vintages considered that would likely underperform because of the high valuation environment in 2019, are now more likely to outperform, given that asset prices are set to drop as a result of the global recession. So that suggests that fund managers that do have significant amounts of dry powder are well positioned to actually make strong returns if they can figure out the problems around deal making they are having now and put some of that capital to work. So now we are hopeful we could see an uptick in deal making towards the rest of the year as managers find their feet in the world and find new routes to put in some of this dry powder, which is at record levels, to work over the course of the rest of the year and into 2021. So finally, moving into how COVID-19 is impacting hedge funds. Starting by taking a look at recent performance within the hedge fund industry. Along with almost every other type of investable asset, hedge funds fell in 2018 due to very, very vicious stock market volatility in the last quarter of the year. On the other hand, 2019 was a much more successful year for most hedge funds, as rising markets buoyed performance. The Preqin All Strategies hedge fund benchmark rose just over 11%. It was one of the strongest years we've seen in the last decade. Heading into 2020, performance almost immediately fell as the first few cases of COVID-19 were reported in Asia and the virus began to spread across the world. And the drawdown was frighteningly quick compared to other market events. In February, the benchmark fell by 2.3%, the biggest monthly drop since the volatility at the tail end of 2018. Then in March, the benchmark posted its worst month on record, falling by nearly 10%, worse than any month in the GFC or the dot-com crash. Following these losses, the benchmark recovered somewhat in April and May, but the average hedge fund is still down 3% year to date. Despite the dramatic drop in March, hedge funds proved their worth during the first quarter of the year when compared to most major market indices. For instance, the S&P was down by almost 20%. It was twice that of the average hedge fund. And I think that's a really key point, is that hedge funds have proved their worth during the cycle, and I think that's something we are seeing investors recognise. Low beta strategies such as macro and relative value funds, as well as CTAs, have protected capital and are in positive territory for the year so far. And unsurprisingly, those with the higher market exposure have fared less well, with equity and event-driven funds the worst hit during March. And looking at this on a regional basis, we've seen funds which focus on Europe and North America outperforming those focused on APAC or other emerging markets such as LATAM. North America focused funds in particular are down 2% per year, while European funds are lagging slightly behind, around 3.8%. And we're also seeing differences between funds focused on specific regions and how quickly they've regained ground lost in Q1. In March, North American focused funds were in a 12% drawdown, deeper than both funds focused on Europe and in APAC. But by the end of May, North American focused funds had quickly climbed back, outperforming European focused funds by around 4.3 percentage points during April and May. And that's really been driven by the stimulus that the US government has put into their economy, which is driving, keeping markets more stable and growing compared to other parts of the world. Having a look at this from a distribution of hedge fund returns shows also a clear positive skew. Most funds have sustained losses so far this year, with around a third of all funds falling by more than 10%. So we are seeing a lot of funds hurting out there. But on the other hand, 30% of funds have seen returns above zero, which speaks not only about the diverse range of outcomes within the industry, but also to the ability of some fund managers to deliver significant alpha in such a turbulent environment. And while finding these hidden gems is key, it's clear that some funds have provided excellent diversification to investors' portfolios this year, and those investors that have found these gems are the ones which have been the most successful. So if the rest of the year is going to be as chaotic as the first half, and I think there's very little reason to believe it will not, what can we expect hedge funds in terms of performance? So looking at hedge funds, let's have a look at how hedge funds performed during the last major crisis. So winding the clock back and seeing how hedge funds fared during the GFC. The worst period for hedge funds was in the second half of 2008, when the collapse of Lehman contributed to losses of nearly 7% and 8% in September and October, respectively. But the overall benchmark's recovery was quick, beginning in December. And between December 2008 and April 2010, the benchmark only experienced one negative month, and that was in February 2009. Do we think hedge funds' returns are likely to bounce back as quickly and convincingly in 2020 as they did 11 years ago? I think it's possible, but I think it's worth noting that the GFC was that of a financial crisis, where COVID-19 is very much a different beast. In fact, it's a healthcare crisis. And we don't know as a world how this will pan out over the course of the rest of this year and into next year. In short, I think it would be wrong to just call this another one of those, considering we're still in the early stages of the COVID-19 pandemic. The longer term effects are ambiguous, and it could have the potential to be very damaging to markets. This is especially true when we compare the tools available to governments and central banks 11 or 12 years ago and what's possible today following years of QE and record low interest rates. So looking at assets under management and asset flows, since the start of 2018, investors have pulled a total of $180 billion from the industry on a net basis. But it should be noticed that this only represents around 5% of the average total industry AUM since that time. In the first quarter of this year, almost $50 billion flowed out of the industry, and yet this still only makes up around 1.5% of total industry assets. Hardly a mass exodus out of hedge funds. But because of these recent outflows, it means that total industry assets have declined from a high of 3.65 trillion as at the end of 2019 to around 3.3 trillion down, and that's a result of the outflows as well as the losses in the first quarter of the year. So moving on from performance and assets, let's look at how investors themselves are responding to the crisis. Our research analysts are having hundreds, if not thousands, of conversations with investors over the course of the pandemic. And many of those investors that we've been speaking to shared that they plan to scale back their hedge fund investments over the next 12 months, in line with the survey results that I showed you earlier. This chart shows you the number of mandates that we've been tracking over time. So that's the number of investors we know are actively searching for funds over the course of this year. Back in January, there's around 744 active hedge fund mandates on the Preqin platform, with expected commitments upwards of 15 billion for those. It will be much higher in reality. These numbers have actually fallen in recent months, so over the last 7 months, and we're now tracking around 644, so exactly 100 fewer mandates than we were at the start of the year. And they're totaling a smaller amount of capital, so just about 12 billion US dollars. So what we're really seeing, in line with the results we saw earlier across private capital and alternatives more broadly, is that institutional investors are putting plans on ice, and those investors that are searching for fewer managers. So again, it will be challenging for fund managers to raise capital as there are fewer mandates out there, and for those mandates there are fewer managers earmarked for that capital. And it does seem like investors were spooked by the volatility in Q1, and those with ideas to make large allocations to hedge funds are reassessing these plans. So in the first quarter of the year, the investors we spoke to that had concrete plans to make hedge fund investments, 9% were looking to invest $300 million US dollars or more as part of that open mandate. In the second quarter of this year, so where we're at now, there's been a noticeable pullback from investors. And those that were planning to invest 300 million or more have now fallen into the the next size bracket down. So they're trimming down their big ticket allocations. At the smaller of this end of the spectrum, not much has changed since Q1, with the proportion of investors looking to make allocations of less than 100 million remaining relatively stable. In terms of strategies, we're seeing investors branch out and target a wider variety of funds compared to the first quarter. I think diversification for investors will be key. We just do not know how this pandemic will pan out, and we do not know what the next impact will be on markets. So I think investors are really looking across a broad array of strategies in order to diversify their exposure and be more protected in all market eventualities. In Q2, investors are genuinely reporting more interest in strategies out of long-short equity, with a significant uptick in those seeking suitable allocations to managers within the credit, distressed and fixed income space. During the quarter, we've heard from investors that some managers believe that there are significant dislocations in the credit space, with distressed credit in particular, and they've been raising funds to take advantage of these opportunities. And we've seen a strong appetite for this, both in illiquid credit, but also in the hedge fund world, in the liquid side of things. In 2019, and this is showing you fund liquidations and launches over time, we noted that there was more fund liquidations than fund launches for the first time ever. Considering the events of the year so far, we very strongly suspect that this trend will continue in 2020. We're already seeing a much smaller number of funds come into market than we would expect by this time of year. And again, liquidations are outnumbering launches. The number of liquidations is likely much higher than the 215 that we currently track, as we receive more data from the industry around the funds that just didn't survive the initial 2019 COVID-19 crash that we've seen. But we're currently now tracking around 16,800 unique hedge funds, a number which has grown substantially since 2012, grown by about 25%. So finally, to summarise, the drawdown in hedge fund performance during Q1 2020 was the quickest we've ever seen. Unsurprisingly, funds with greater market exposure, such as those in the equity space and event-driven funds, experienced deeper losses than those with lower market exposure, such as CTAs or discretionary macro funds. For hedge funds, some progress has been made towards recovery, but there's still plenty of unknowns in the market, and we yet have a clear idea of how the medium to long-term effects of the COVID-19 crisis will play out. Although most funds suffered losses, around 1/3 ended the year in the black, with a small slice of those funds generating double-digit returns so far this year. While the average hedge fund is down around 3%, there are clearly some of those that have been successfully able to navigate the volatility, and some to quite significant success. In terms of industry AUM, that fell by around 344 billion in Q1, with around 48 billion in capital outflows and capital redemptions. These outflows only represent about 1.4% of the total industry assets. With hedge funds likely to have dampened losses in investor portfolios during the first half of the year, it would be interesting to see whether assets continue to flow out of the industry, and if so, in what volume. And perhaps is there a potential to win investors over through the crisis by being able to successfully navigate any downturn that we see. According to our conversations with institutional and smaller private wealth investors, most are understandably cautious about the future. Many are scaling back their planned commitments this year. Still, appetite for hedge funds remains, and in particular, credit funds are being targeted by investors as they seek to take advantage of the price dislocations that have emerged from the market turmoil. And finally, to finish on a positive note, investors are certainly planning to stick with the programme. While investors are lowering their immediate commitment plans to COVID-19 as a result of COVID-19, they retain a longer-term confidence in the alternative asset classes. And we believe that alternative assets will once again prove their worth through the fallout of the economic crisis triggered by the COVID-19 pandemic. So with that, thank you for your time, and I'll get back to you, Zach, I guess, for Q&A.
So Amy, I have so many questions. We also have a live Q&A from the audience. We already have some questions coming in, so please feel free to ask questions. Certainly, again, I'm a huge fan of Preqin and all of the data that you provide. We regularly consume your data. It gives us excellent market intelligence. And thank you so much for having data in this presentation that is up to date as of yesterday. It's really incredible to have such a timely view in the market. One of the questions I have with respect to the hedge fund industry in particular, you highlighted some of the dispersion of different performing hedge fund managers. And while again, actually in this webinar series, a few months back, we had a webinar with Dr. Nassim Taleb, and he was talking about Mediocristan and Extremistan, and different kind of dynamics that are actually, the average is driven by the outliers. And you mentioned around 3 or 4% of hedge funds that have really knocked it out of the park over this period. As a matter of fact, actually one of the hedge funds on our platform is in that category of having just knocked it out of the park and really delivered for investors. Compared to what you normally see in terms of dispersion, how has dispersion been higher during this COVID 2020 period, with the top quartile managers outperforming more than they normally do, or has it been less, or has it been about the same? I'd be really interested to understand, how the best of the best are doing compared to the worst of the worst, and how much that average is being biased by those extreme outliers.
I would say the way that I see the dispersion is it's much more pulling the barbell. It's a much narrower slope towards the end. So there are, I think, a lot of managers, a lot of funds are performing quite similarly on the tail end. So in terms of, underperforming, well, not underperforming, they're overperforming relative to public markets. But as a whole, we've seen, lots of funds having similar problems and being, somewhere between 0 and minus 10%. And I think that's actually, less dispersion than we'd usually see in that case. But there's a very long tail of funds which are, performing better. So we are seeing that top group of funds that are performing really well. That's actually smaller than we'd usually see. So I think the dispersion is actually narrower in the negative side of things, with that long tail of the better performing funds out there. And I think there are a few funds which have really done well at identifying opportunities in the market, and that's something that I strongly believe hedge funds are good at doing. I think hedge fund managers are innovative. I think hedge fund managers do find opportunity in crisis, and we're already seeing this year there are some funds out there that are knocking out of the park. And I expect increasingly this year we will see more funds do better. We're looking at the US funds and the strong recovery they've had. I think as we move through the crisis, we will see a lot of these credit strategies we've seen emerging do very well. So I expect that dispersion to move to the right, and we will see funds emerge out of it better. But I think it just shows the ability of hedge funds as a group to find new strategies, to pivot really quickly. And when we've been speaking to customers, we're hearing from investors that they're really happy with many of their fund managers. You mentioned there's a fund that you work with. Now I was speaking to a fund of funds last week, and he was just really, really pleased with how a manager came to him with a brand new strategy off the back of the moves in March, and they're able to get good gains off of that as a result. So I think it's we are seeing the industry evolve quickly, and I think we expect to see that dispersion move to the right of the chart and funds get out of that negative territory.
So one of the audience members has asked whether the slides are going to be shared. I'd like to confirm to everyone that the slides will be shared for everyone who registered for the event. And in addition to the slides, Preqin has been extremely generous in giving complimentary access for everyone who's joined this webinar to their hedge fund data report. This is a highly valuable report. If you buy it on Preqin's website, it costs hundreds of dollars. So thank you so much, Amy, for agreeing to share that with everyone in the audience. These are, again, reports that we consume and subscribe to. As a matter of fact, a lot of these charts that you presented are actively in some of our presentations that we use investors, including one that I'm interested in about before I start handing over to some interesting questions coming in from the audience. And that is around this 14 trillion number. So you guys, I think the first time I saw this 14 trillion number from a Preqin report was from your 2018 alternative outlook. And that's when you anticipated this 2023 14 trillion number. And I'm interested to see 2 years later, this 14 trillion is still on track. Do you still think that that number is going to happen, or how confident is Preqin, and now post COVID-19 with different changes in investors' appetite? Has that derailed this 14 trillion number? Is that going to happen in 2023? Is it going to be 2024? I'd be very curious to see where we are on that particular AUM growth expectation.
Well, firstly, thank you for saying all those kind things about our data and our reports. It really does mean a lot, and we are very happy to give you all complimentary access to that report, because we know it's challenging times and everybody needs data and information to help them get through. So please do download that report, and if you do have any questions, my contact details will be on the slide. Always drop me an email. We've all got plenty of time on our hands, so I'm more than happy to help answer any questions that you have. To the question around the $14 trillion aim we see for the alternative asset AUM by 2023. I think coming into 2020, I think we were expecting to hit that by 2022, end of 2022. Growth has been so strong, particularly in private equity over the last few years, that we were really expecting that to continue, and all of the signs were there that could have been hit earlier than 2023. Do I think today that the alternative asset industry will be $14 trillion by the end of 2023? The answer to that is no. I think it will be higher. I think that estimate is far too conservative. I think we would now rebase it up, and I suspect data scientists and data wizards in the business are doing more work into evaluating where we really do see it going. But there's lots of reasons for this. So now I think 2020 will be a difficult year. You look at the survey results we put out, 60% of investors were planning to reduce their exposure as a result. They were planning to make fewer commitments because of COVID-19. But if you look beyond 2020, we spoke to investors back in April. 63% said that they plan to keep their strategy the same, and 30% said they plan to invest more in alternatives. So I think there's really strong evidence that although it may be fundraising will be challenging this year as investors find their feet, put portfolios on ice, I think longer term the real need for alternatives will remain. So what we're really expecting is a short-term slowdown in all activities, so fundraising, deals and exits, that sort of thing, as both investors and managers find their feet and figure out how to do remote diligencing of new managers, of assets. We think the medium term, there'll be, we'll go back to the established growth trends, with alternative assets have delivered good returns through previous market downturns, so we think they will do so again. We also think that some of the very best investments will be made in the next year or the next second year. So some of the best investments from private capital world are made during the depths of the downturn and the recovery from it. So there's so much dry powder out there that can be put up to good work. We think the vintages of 2019 to 2022 can be actually standout performers. I think that's a reason why actually investors should be thinking about putting more money into private capital today. So we think, yes, fund commitments were slow in 2020. I think that will be for a couple of reasons. So the difficulty of completing on-site assessments, but LPs are bullish, medium to long term. And we see lots of interest in certain sectors as well. So we think, money will be particularly earmarked this year for healthcare, logistics, software, distressed debt, and money moving out of retail and retail investments. So what we really think is that this $14 trillion target is actually quite conservative, because it's actually COVID-19, I think, will reprove the value that alternative assets have for investors. Even on the hedge fund side of things, you look at the first quarter of this year, CTAs did well. They did what they had to do. CTAs are much maligned part of the sector. I think that gives investors confidence in alternative assets. And we fully expect that to continue through the crisis, both on the hedge side and the private capital side. So we think short term, okay, let's figure out where we're at. Long term, actually, this could mean more money coming in. So I'm still hopeful that it's 14 trillion in 2022.
Well, I'm so glad to hear that. And I'm, again, glad to hear you further endorsing clients putting more assets and increasing assets into the alternative industry. Again, I think part of it is also being driven by where else to invest, right? Where else to, go out and buy the index, go out and, you need to find, in order to generate any kind of excess return, that you need to be actively managed, you need to be taking an alternative strategy, you need to be looking for, I actually usually drop the H in hedge funds and I look for edge funds, right? We look for edge, we look for alpha, we're looking for something to add value, and a lot of that value add also has, there's been a lot of fee compression in the space. I think we can't ignore that. That's a whole different topic in and of itself. And I know that anyone who wants to understand hedge fund fees and the history of it, look at Preqin's data. They cover this. They cover, what are hedge funds actually charging, in the days of 2 and 20 are basically, over for a lot of hedge funds, except for the superstar managers. So I think, hedge funds are really adding value to investors' portfolios. Private capital is definitely adding value to investors' portfolios. Where else to invest today? It is very difficult. Now, some of the questions that have come from the audience, Ranajoy Mazumdar has asked, why have hedge funds following macro strategies performed the best, and have those following event-based strategies had the worst returns in the post-COVID-19 crisis? Amy, love to hear your thoughts on that. I also have a few comments to add to that one as well.
Yeah, I mean, I'm sure, Zach, you've got much deeper insight into this, but essentially macro strategies, the whole point of macro strategies is to have less correlation to public markets. So when public markets tanked in March, I think macro strategies were there to save the day, just the way that they invest. And I can talk on the investor side of things about this. Is there has been an expectation there was going to be a correction for the last several years, and when we talk about outflows from the industry, in the macro and the CTA side of things, and these are two strategies which do show less correlation to public markets, we've seen actually inflows into those areas. I think investors have been waiting for something to come, and we're seeing a lot of money go into that. And that's why I think investors are quite satisfied at the moment with hedge funds, because they did have that safety net for them. And when S&P isn't continuing its strong upwards slope, they've got products in their portfolios to help protect them on the downside, as well as adding yield. So that's fundamentally how macro strategies work, whereas event-driven funds are more exposed to those markets, and therefore when there's problems, they will be impacted. But Zach, I'd love to hear your thoughts on that as well.
Yeah, exactly. I mean, again, and let's look at that edge. Where is the edge that macro managers add? Where is the edge that activist and event-driven managers add? Macro managers, what they're looking for, and I'm sure out of the tail guys that were generating the plus 20% plus returns, I wouldn't be surprised if most of those or all of those were either your CTAs that you cover or the macro guys that you cover, who just smashed it in the last few months. Now, the macro guys, what they're looking for are large concentrated directional bets in rates, in FX markets, and these are generally driven, a lot of these can be policy driven. So they love markets like this, right? A very good macro manager, they can anticipate how the Fed is going to react. They can anticipate what the ECB is going to do. They understand what's happening. They're reading these Fed minutes. They're reading exactly what these policymakers are going to be doing that is driving markets, and they're taking concentrated directional positions to benefit from those. So these kind of markets are where very good macro managers thrive, and some of the best macro managers are completely knocking it out of the park, because they know the Fed's playbook, they know the IMF's playbook, and they know how to predict the market impact that these organizations are going to have. In the event-driven space, a lot of these strategies are dependent on mergers happening. As you've seen, there's been a huge decline in merger and acquisition activity. So they're adding value a lot. First of all, these are long bias strategies. They have a lot of beta exposure, whereas macro tends to have zero, or in a lot of cases negative beta exposure. So these are high beta strategies. They are convergent strategies. They tend to thrive when M&A activity is doing very well. That tends to happen, late cycle, when the market's very strong. So they would have been the most negatively impacted during this period. It's not that these managers aren't adding value to the portfolio, but one of the data points that I was really surprised to see was when looking at inflows and outflows was that from Q1 to Q2, it looked like there was less appetite for CTAs, even though historically, if you look at 2008, CTAs had some of their best returns, in history in 2008 and the period after 2008, because you have big trends, right? And these tend to be trend-following funds, so they benefit from these trends. I was really surprised to see that data point, but given the amount of time that we have, I'm not sure. We're down to the last 4 minutes. I'd like to get some more questions from the audience. One of the audience members has asked, and you covered in the private capital section, and I know that you have a very strong tracking of the VC space. They asked how VCs have performed compared to other alternative asset classes, and if there has been any notable response or data that have come out in that space in the post COVID kind of market.
Obviously, capturing VC performance is, real time is a challenge. So usually, we get performance figures about 6 months after the date of the performance. So we are actually just about waiting for the first COVID-19 performance data points to come in. Now, what we've seen in the VC space, it has been hit particularly hard in terms of deal making, particularly in the first quarter of this year. So a lot of fund managers in the VC space, it's all about relationships. It's all about meeting people and being on site with portfolio companies. And I think it's a real challenge for those VCs to actually go out there and invest at the moment and, value companies. How do you value companies when markets are all over the place and perhaps being artificially buoyed by some of the financial easing that we see? And so I think that's been a real concern we've seen in the VC space. That's not to say there's not been activity. We are seeing a lot of activity, and that actually recovered in Q2. So it was a significant dent in the Asia VC space in Q1, very unsurprisingly, but a strong recovery in the second quarter. So we are seeing managers get out there and put some of this dry powder to work in the sector. In regards to performance, VC, as you'd expect, shows a lot of dispersion of returns. So to the point you made earlier, Zach, the average return will be a mixture of the outliers, the ones that are really pulling it. You'll have some VCs who absolutely knock it out of the park. They've got really, really incredibly high multiples on their vehicles, and there'll be some that every bet they made was a bad bet, and that can pull the returns down. So in general, if you look at a VC benchmark, it's not performing as well as a buyout benchmark, for instance, or the private equity benchmark that we showed you earlier, and it is much more volatile. But the point of VC is you can get access to that, the guy who's finding the unicorns out there, and get early access to some of these really, really strong opportunities. And I think that's the exciting nature of VC, is that it is higher risk but potentially higher return. And I think it will continue to be a really important part of the world post-COVID. But it's just a case of finding the right GPs and finding the right investments. And I think actually what we see in VCs, that's starting up again this quarter.
Well, Amy, I hope you don't mind. We have questions continue to come in. So if you don't mind, if we go about 5 minutes over time so we can address a few more questions. And again, from the audience, I probably have time for another 2 or 3 more questions. So please keep them flowing. One of the questions from the audience is around impact investing. And it wasn't actually separately tracked in the data, but something that we've seen is the assets under management of impact funds growing year after year. This has been one of the fastest growing kind of segments of principally the private capital asset class, although there are some liquid strategies as well. How has that changed post-COVID? Has COVID slowed this trend, the fall in energy prices? Are people thinking ESG isn't in line, or has it accelerated the trend? Has there been an impact? I'd love to understand what you're seeing on the ground.
Yeah, perhaps I'll group ESG and impact together, although I do know that they're slightly different, but I think it's important. It's something we're thinking a lot about. So Preqin as a business, we've been heavily thinking about ESG, I'd say, for the last 3 years. And it's something we're actually heavily investing in, is our data coverage of the ESG world. As somebody that sits in the hedge fund world, what I have seen is that ESG adoption amongst hedge fund managers has been much lower than, say, in private equity. I suspect the pandemic will only accelerate the adoption of ESG and the number of impact funds that are out there and the amount of impact investments that are made. You know, we see the hedge fund world as lagging their private capital counterparts, but we do see a lot of appetite from LPs for hedge funds to adopt ESG as part of their investment criteria. So really what I think is COVID-19 will accelerate the trend. The current pandemic has highlighted the shortcomings in public healthcare systems. New challenges are mounting on existing social and economic inequities, and that's really raising the awareness for the need of investment capital to bridge the gap for a more sustainable and equitable world. So yes, there are challenges with ESG implementation for hedge funds. I think there's a sense of urgency for hedge funds to solve these challenges and to embrace it. And I think we will see that adoption for ESG and number of impact funds in the market increase as a result. And personally, the way I see this pandemic is changing the way we as humans are thinking about the world and our part in it. And I think that will lead to more people wanting to adopt ESG factors for reasons beyond just policy making or regulations. So I think actually we will see people do it for more ways around values and how they as a company want to invest. So, you know, I'm very bullish on it. I think we will see ESG become mainstream in the next 2 to 3 years, and in hedge funds in particular, which is I don't think would have happened without the pandemic.
Absolutely, and I would tend to agree with you. You know, that what we're seeing is, yes, okay, energy prices have come down. Conventional energy prices have come down. People would think, oh, well, maybe the returns aren't as attractive in solar and other environmentally friendly spaces. But actually, I think that what this pandemic has highlighted is we had these warning bells, right? We knew that something like COVID could happen. I mean, look at Bill Gates been talking about it for years, right? And people, and all of a sudden, you know, it hits and we're not prepared for it. And I think this has woken up people to, let's pay attention to the scientists, let's pay attention a little bit to the data, and we need to take action before it's too late. Because again, as this pandemic has highlighted, being prepared and taking action before rather than after is critical. And we're going to see, we're not just going to see that driven by investor inflows and investor appetites, but policy changes. You know, everyone has looked to government and said, you know, why didn't you prevent this, right? You knew that this could have been stopped. So anyone running a government right now is not just going to be thinking about what happened to COVID-19 and how can we be better prepared, but they're going to start thinking, you know, we've got this other crisis on our horizon, the climate crisis, and we need to start really more aggressively implementing policies that are going to see that, which is going to negatively impact some companies and it's going to be positively impact others. So I think that this has really accelerated impact investing. You know, in the very, very short term, there you know, energy prices and some other macro factors may have constrained things, but anybody who's investing in impact in particular is, you know, investing with longer time horizons and is thinking about what's going to be happening, you know, thinking of this as a super trend, as was discussed in our last session. One of the other data points that you discussed was the emergence of or the continued appetite towards the mega funds, right? The mega funds are really dominating the landscape, and you know, one of the things that we've had to come to grips with is that we also see that, yes, the mega funds can be great, but there are a lot of opportunities that you need smaller managers for. That you know, we're talking about Hedge, we're talking about being, you know, in a lot of ways very tactical and being able to be nimble and to deliver alpha to investors. And this is, you know, where we have tried to, Down the Capital has tried to play the best of both worlds. We run a fund platform where we look for those emerging managers that have the edge, they can generate that alpha, that have highly specialized and niche strategies and can outperform, but allow them to become part of a bigger platform, part of a bigger asset manager that has, can give institutional investors the comfort. Now, I wanted to understand, and I think this would probably be the last question that we're able to touch upon, but one of the other data points that wasn't highlighted in this presentation, but has been highlighted in some of your other data, has been where capital comes from for the alternative investment industry in general. And pre-2008, it was highly driven by high net worth individuals and by wealthy families, right? That was, I think, around 65% of AUM. And post 2008, that has basically reversed, and it's become very much an institutional investor class. So, would you tend to agree, or are there any other points that you could comment on, that this tendency towards the mega funds is possibly being driven by the institutionalization of this asset class, and the fact that institutional investors, at the end of the day, these guys tend to be allocators who, you can't get fired for allocating to Fidelity, right? As they say. You're not going to get fired because you invested in a Blackstone fund. So, that's something that I'd be curious to see, how the change in the investor universe, the investor base for the alternative industry has driven this tendency towards mega funds, and if you would tend to agree with that.
I do agree, and I think there's a few points there with that, really. So pre-2008, most big institutions only had very small allocations to alternatives, if they even did have an allocation to alternative. GFC happened. I think that really proved the case. You need to be diversified. You need to have a source of yield. You need to start investing in alternatives, and that's why we've seen this really strong growth over the last 12 years, really. And to your point, many of these big investors, are concerned about headline risk. They do just invest in the largest funds because you're not going to get fired for investing in a KKR, for instance. But equally, they can't invest in the smaller funds. Their ticket size is too big. And what we have seen is, establishment of emerging manager programs, for instance, going via fund of funds, where I think a group like Dalma could be really, really valuable in this market. Is exactly what you're doing, is offering investors routes to smaller funds, which can do, to your point, add edge in a portfolio, because that is my concern out of all of this. I'm concerned that all of the money will be flowing just into the biggest managers because investors have existing relationships with them and because they can't do on-site visits. And what we hear from investors is that they don't want to invest unless they've met that manager in person. And I'm concerned that will make it really hard for smaller emergent managers to raise capital. So I think a group like Dalma are really going to be important in this and helping to, get groups of really, really good managers, which may not be, of the brand awareness that some of these bigger funds have out there. And that could be a way that even big investors can get access to smaller managers, but also smaller investors. There's a lot of family offices out there that are trying to find routes to new hedge funds. There's a lot of smaller private wealth investors. So I think there's a lot of things going on in the market. What we see with the biggest LPs, which is also driving this rise of the mega fund, is around fees. So we've discussed fees briefly. I won't go into it at length, but particularly in the private capital world, there's a real need to consolidate the number of relationships you have with GPs, specifically to reduce the amount of fees you're paying. So again, this conversation on fees, I think, could help solve the problem. There's innovative ways of charging fees, reducing fees. Fees have come down in hedge funds, not so much in private equity, if I'm honest, because it's been doing so well. I think that may be a way to differentiate yourself. But I said, when we speak to LPs, there's certainly a sense of we're not going to invest in smaller managers through the pandemic because they haven't done that diligence in on site. I think everybody's used to doing remote working, but I think there's still that relationship aspect. So having groups that can facilitate that, I think will be really important. And I think that's a key change we may actually see, is that the way that investors find funds and get access to them could be different. And I think that's very, very key.
Well, thank you so much, Amy, and I really appreciate you saying that again. Our platform is really trying to add value both for investors and for managers to be able to find that edge, to access it, to get comfort, to know that you're part of an institutional platform that to really get the best of both worlds. We covered so much in this discussion. We discussed the emergence of, or the continued growth of these super trends, or the super mega funds that are kind of taking over the industry. We not only stuck to, but actually revised higher the estimate for the assets under management of the alternative investment industry. It is clearly a time where alternatives have demonstrated value to their investors. They've demonstrated the diversification benefits. Some of them have significantly outperformed markets. You highlighted why the global financial crisis may not be the perfect guide for what happens next, and some of the key differences. You've also highlighted the rise of impact funds and ESG investments, and whether that's going to be accelerated by the COVID crisis. For everyone that dialed in, again, please keep an eye on your email. You are going to be getting access to the frequent hedge fund report. It's a highly valuable report. You just saw the tip of the iceberg in terms of the data. So look forward to sharing that with everybody. Again, thank you so much for joining the webinar today. I hope you found it useful. I hope you found this information of take-home value. We'll also send the slides that Amy prepared specifically for this presentation, which, as we noted, includes data that are up to date as of yesterday, which is, I can't thank you enough for doing that, for providing it to the group. Thank you all for joining. Looking forward to hosting you for our next webinar, which is going to be taking place next week. Unique market dynamics in private credit post-COVID-19, focused on Europe and Asia, untapped opportunities and unforeseen risks. This is one of the areas that we highlighted. As you've seen in Amy's presentation, private credit has been one of the fastest growing segments of the alternative industry. So we're looking forward to taking a deeper dive into that and sharing with you a little bit more about the opportunities and risks in the strategy. We're joined by Tikehau Capital and by the team at ShoreVest Partners, which are the leaders in European private credit and Chinese private credit markets. Thank you so much, everyone, for joining, and hope to see you next week.